Three things just happened in the last 48 hours. Silver plunged 10% in a single move. Bloomberg ran a piece quietly dissecting gold's resilience, and in doing so exposed a structural contradiction no one on television is addressing. An open interest in silver futures barely flinched. That combination does not happen in a healthy unwind. It happens when something underneath the surface is shifting. On the surface, the narrative is simple. Volatility. Profit-taking. Overextended positioning. But that explanation collapses the moment you look at the structure. Because when silver drops 10% in a disorderly move, you expect liquidation. You expect open interest to fall sharply. You expect ETFs to bleed. You expect dealers to report weak traffic. Instead, positioning stayed sticky. Registered inventories did not surge. And physical premiums in key regions did not collapse in proportion to the paper move. That is not normal. At the same time, gold did not break. It dipped. It absorbed. It stabilized. Which is precisely what Bloomberg highlighted. Gold's calm in the face of cross-asset volatility. But here's what they didn't connect. If gold is stable while silver collapses, and miners are reporting realized prices above benchmark averages, and option skew is tilting toward upside calls, then this isn't a simple risk-off flush. It's a repricing event. And repricing events are about structure, not sentiment. Now lay a policy on top. Recent policy signals have narrowed the probability window for aggressive rate cuts. Bond volatility has increased. Real yields remain elevated. That pressures leveraged longs in metals, especially silver, which carries higher beta and thinner liquidity. So if macro pressure forced liquidation, why didn't futures positioning collapse? Why didn't commercial hedges aggressively cover? Why didn't physical supply suddenly flood the market? Because the move may not have been about fundamentals at all. It may have been about derivatives positioning and margin mechanics. When volatility spikes, margin requirements rise. When margin rises, weak hands exit. When weak hands exit into thin liquidity, price overshoots. That is mechanics. But mechanics do not change supply-demand reality. And this is where things get interesting. Because beneath the headline drop, the structural tightness story hasn't vanished. Industrial demand remains structurally elevated. Solar, electrification, defense systems. Mining supply growth remains constrained. And registered inventories relative to open interest remain historically stretched. Which means the drop could either be a warning that demand is collapsing, or a pressure reset before the next regime shift. By the end of this video, you're going to understand which of those is more probable. You're going to see how policy signals, miner earnings, physical dealer data, and options positioning all intersect. And you're going to realize why the 10% plunge may have revealed more strength than weakness. Let me show you why. Policy. Government action start with policy. Because policy sets the liquidity regime. Over the last several weeks, central bank communication has shifted from aggressive easing expectations to cautious patience. Inflation data came in mixed, not re-accelerating sharply, but not collapsing either. Labor markets remain tight enough to prevent immediate rate cuts. Bond markets reacted. Yields pushed higher. Real rates stabilized at levels historically restrictive for non-yielding assets. Now translate that into metal mechanics. Gold and silver compete with yield. When real yields rise or remain elevated, leveraged speculators face opportunity cost pressure. That pressure shows up first in silver. Why? Because silver trades with higher volatility, lower liquidity depth, and higher margin sensitivity. So when policy narrows the easing window, macro funds trim high beta exposures. That is logical. But here's the nuance. Policy has not tightened further. It has simply delayed easing. There is a difference between active tightening and slower accommodation. If the market had been priced for rapid cuts and that pricing was wrong, repricing downward is mechanical. But mechanical repricing is not structural demand destruction. It is positioning adjustment. And positioning adjustments create volatility spikes without necessarily altering long-term supply-demand equilibrium. Now consider fiscal policy. Defense spending remains elevated. Infrastructure spending remains committed. Industrial subsidies continue to support electrification initiatives. Silver's industrial footprint intersects directly with those themes. So while monetary policy pressures short-term price, fiscal structure underpins long-term demand. This creates tension. Short-term liquidity pressure. Long-term structural consumption. That tension is precisely where violent price swings occur. Not because the thesis collapses, but because leverage meets uncertainty. Now let's move from policy to corporate signals. Corporate earnings of minor signal mining companies have recently reported earnings reflecting realized silver prices that, in several cases, exceeded quarterly benchmark averages. That matters, because miners don't realize spot price at one moment. They realize blended pricing across contract timing, hedging, and delivery windows. If their realized price is strong while spot collapses late in the quarter, that tells you something. Two explanations exist. First explanation. The drop is forward-looking. Markets anticipate demand slowdown or economic contraction that will pressure future prices below current realized levels. Second explanation. The drop is technical, driven by positioning, not fundamentals, and miners are still benefiting from tight physical markets that have not yet softened. Which is more likely? Look at production guidance. Most major primary silver producers are not dramatically increasing output. Cost pressures remain elevated. Energy, labor, and regulatory friction continue to constrain expansion. If miners believe demand collapse was imminent, we would likely see defensive commentary cutting capex, revising forward guidance aggressively lower. Instead, guidance remains cautious but stable. No dramatic demand panic. Additionally, if physical demand were collapsing, smelter treatment charges would widen aggressively. We have not seen evidence of that magnitude of shift. So the minus signal does not confirm structural demand destruction. It suggests stability beneath volatility. Now move to the physical layer. Physical market evidence. When paper price collapses 10%, physical markets respond. Dealers adjust premiums. Retail demand either surges or disappears. Industrial buyers either delay procurement or accelerate it. In previous episodes of sharp drops, retail often steps in. Discounts on futures widen, but coin and bar premiums remain sticky. If premiums remain above historical averages despite a futures plunge, that indicates physical tightness. Shipping delays are another tell. If refiners and mints report backlogs even after price drops, that indicates demand absorption. Now consider international divergence. If London spot and Asian premiums diverge meaningfully, that suggests regional tightness. Physical arbitrage typically closes these gaps quickly. If it does not, supply chains are constrained. We are not seeing a flood of secondary supply overwhelming refiners. Scrap flows respond to price strength, not weakness. So a sharp drop actually reduces scrap incentive. That can tighten supply further in subsequent months. Again, volatility does not equal oversupply. It can actually suppress marginal supply. Now let's escalate to derivatives. Derivatives of futures options pressure. This is where the real story sits. Open interest in silver futures relative to registered inventory has historically been a stress indicator. If open interest remains elevated while price drops sharply, that means positions are being transferred, not extinguished. Margin hikes amplify this. When volatility spikes, exchanges raise margin requirements. We've seen this before. Higher margin forces smaller participants out, but larger participants with capital absorb contracts. This transfers ownership from weak to strong hands. Now layer options. If traders accumulated large upside call positions before the drop, dealers who sold those calls will long gamma. When price rises, they buy futures to hedge. When price falls, they sell. That accelerates downside in thin conditions. A gamma unwind can produce exaggerated moves disconnected from fundamentals. Delivery math is also critical. If a large percentage of open contracts stand for delivery relative to registered stocks, stress increases. But delivery rarely hits theoretical maximum. Most contracts roll. The risk is not mass default. The risk is perception of tightness that triggers volatility. Right now, the probability distribution suggests stress but not collapse. Which brings us to the convergence. The convergence thesis: policy, delayed easing. Yields pressured leveraged longs. Margin mechanics forced liquidation. Options positioning amplified downside. But miners remain stable. Physical premiums remain sticky. Fiscal demand drivers remain intact. So what does that imply? This was likely a leverage reset, not a demand collapse. And leverage resets often precede structural moves. Because once weak hands exit and margin stabilizes, positioning can rebuild on firmer footing. The real question is whether macro liquidity conditions deteriorate further. If they do, metals could face extended consolidation. If they stabilize while structural demand persists, the flush becomes a base. Silver's history is not linear. It moves in volatility regimes. Calm compression, violent expansion, reset, reacceleration. A 10% plunge feels catastrophic in the moment. But in historical context, it fits within regime transition behavior. The market is not signaling the end of the metals thesis. It is signaling stress within the leveraged layer of that thesis. And stress transfers ownership. Ownership transfer precedes trend shifts. Now let's close this strategically. 4 signals matter most. Policy delayed, but did not revise, easing expectations. Miners reported stability, not panic. Physical markets did not collapse alongside futures. Derivatives positioning amplified a mechanical downside move. Individually, each signal can be dismissed. Together, they form a coherent picture. This was not a fundamental implosion. It was a structural reset. Over the next 6 to 24 months, the metals complex will respond to one dominant variable: liquidity regime. If real yields remain elevated and growth slows sharply, volatility persists. If policy pivots while fiscal demand remains firm, metals reprice higher. Risks exist. Industrial demand could weaken if global contraction accelerates. Dollar strength could suppress speculative flows. Geopolitical easing could reduce safe haven demand. Those are real possibilities. But the structural constraints in mining supply and the embedded industrial demand floor create asymmetry. Silver does not need panic to rise. It needs alignment. Alignment between policy uncertainty, constrained supply, and derivative positioning. We are not there yet, but we are closer after a reset than we were at euphoric highs. The loudest voices focus on the 10% drop. Serious capital focuses on who absorbed it. Because markets are not moved by headlines. They are moved by structure. And structure just shifted. Not loudly, not dramatically, but meaningfully. The next phase will not announce itself. It will build quietly in positioning data, in inventory reports, in miner commentary. The opportunity is not in predicting tomorrow's price. It is in understanding the rare aim. And regimes change when stress exposes fragility. This drop exposed leverage fragility. It did not expose demand collapse. That distinction matters. Stay analytical. Stay patient. Watch the structure. Because something larger than a 10% move is unfolding. And those who understand the mechanics will see it before the headlines do. Now let's go deeper. Because the most important shifts in markets rarely announce themselves with clarity. They show up as contradictions. A violent 10% plunge, without structural inventory expansion. A mainstream narrative of weakness, while miners quietly report stable margins. A headline about gold's resilience, without acknowledging what that resilience implies about monetary confidence. These contradictions matter. And here's why. Markets operate in layers. There's the narrative layer, what gets published, debated, amplified. There's the positioning layer where leverage builds and unwinds. And then there's the structural layer: supply, demand, fiscal direction, industrial necessity. The narrative right now is simple. Volatility equals fragility. But volatility is often the cost of transition. If we zoom out, silver historically does not move in straight lines during macro regime shifts. It compresses. It frustrates. It violently ejects weak capital. And only then does it trend. What we just witnessed fits that behavioral pattern. Now let's talk about time horizon. Over the next 6 months, metals will trade primarily on liquidity expectations. If inflation remains sticky and rate cuts remain delayed, silver could stay volatile, range-bound, even pressured. If bond volatility increases further, forced positioning adjustments could continue. That is the new term risk. But beyond that 12 to 24 months, the variables shift. Fiscal deficits are not shrinking. Strategic industrial policy is not reversing. Energy transition initiatives are not being dismantled. Defense procurement is not slowing meaningfully. and global mine supply growth is not accelerating fast enough to create surplus comfort. These are slow-moving forces. They don't react to a single CPI print. They don't disappear after a 10% futures flush. They build quietly beneath price noise. Now consider psychology. Retail traders react to price. Institutions react to structure. A retail participant sees a plunge and assumes something broke. An institutional allocator asks, did inventory surge? Did producers hedge aggressively? Did physical premiums collapse? Did forward curves invert violently? If the answer to those questions is not materially, then the event is reclassified. Not collapse. Reset. Resets are uncomfortable. They test conviction. They punish leverage. But they also create transfer. Transfer from momentum participants to balance sheet participants. And balance sheet participants do not trade emotionally. They trade probability distributions. Right now, the probability distribution for silver over the long term has not deteriorated materially. Short term, uncertain. Medium term, dependent on liquidity. Long term, structurally supported. That does not mean price goes straight up. It means downside is increasingly mechanical rather than existential. Now let's be intellectually honest. There are alternative outcomes. If global growth contracts sharply and industrial demand declines materially, silver's dual identity as both industrial and monetary metal could create extended weakness. If the dollar strengthens significantly due to global capital flight, metals could underperform. If policymakers maintain restrictive real rates longer than expected, speculative flows could remain suppressed. Those are real scenarios. Ignoring them would be reckless. But we must weigh probabilities, not possibilities. And the current evidence does not suggest systemic breakdown in physical demand or producer stability. It suggests stress within leverage paper positioning. That distinction changes how long-term capital interprets the move. Another critical point. Major macro turning points often begin when mainstream narratives feel confident. Right now, the confident narrative is that volatility invalidates the bull thesis. But volatility has historically been a feature of early-stage commodity repricing cycles. Not the end of them. The real shift to monitor from here is ownership quality. If open interest rebuilds with stronger hands. If ETF holdings stabilize despite volatility. If miners maintain disciplined capital allocation. If central banks continue accumulating gold quietly. These are the data points that matter more than a single red candle. We are watching for confirmation, not prediction. And confirmation does not come from headlines. It comes from consistency across independent signals, policy direction, inventory trends, producer margins, industrial demand, option skew. When those align, price eventually follows. Right now, alignment is incomplete, but it is not broken. And that is the subtlety. This moment is not about panic. It is about interpretation. If you interpret volatility as failure, you exit at reset lows. If you interpret volatility as structural stress transfer, you observe patiently. That does not require blind optimism. It requires disciplined observation. Metals markets reward those who understand plumbing, not those who react to noise. So as we move forward, focus on structure. Watch registered inventories relative to open interest. Monitor minor guidance revisions. Track physical premiums versus futures price. Observe bond market volatility as a proxy for liquidity pressure. These are the real signals. Not a headline. Not a single session drop. Because major macro transitions are quiet before they are obvious. And by the time they are obvious, price has already adjusted. The 10% plunge was loud. What it revealed underneath was quiet resilience. And quiet resilience during stress is often the earliest signal of something larger building. We are not at euphoria. We are not at capitulation. We are at recalibration. And recalibration phases are where informed capital positions thoughtfully. No guarantees. No certainty. Just probabilities. But the probabilities right now suggest that something structural is shifting beneath the surface of silver and gold markets. The question is not whether volatility will continue. It likely will. The question is who owns the metal when volatility subsides. That is where cycles are decided. Stay analytical. Stay skeptical even of this thesis. But most importantly, Stay focused on structure over narrative. Because in macro markets, structure always wins. And this structure is far more interesting than a 10% headline drop.